Hello, ladies and gentlemen. My name is Ruth Beddoes, and I'm the Managing Director of Global Capital and Euromini Conferences. With me today is our keynote speaker for the Global Borrowers and Investors Forum. Obviously, we can't all be together as we planned in London, or in fact anywhere at all. So I'm very grateful that Mr. Flowers has decided to join me on Zoom. I feel very advanced in my technological understanding since the COVID experience started. JC Flowers is the chairman and CEO of JC Flowers & Co. From 1979 to 1998, he was the global head of financial institutions at Goldman Sachs and has held active investments in over 10 global financial services firms. I'm delighted to welcome you today, Chris, and I look forward to discussing a few of the problems, not only to do with the pandemic, but of course, mainly focused on that. So welcome.
Thank you, Ruth. Thank you for having me.
So I'd like to kick off by discussing your own pedigree in bank funding and bank refinancing and even restructuring. So with that in mind, I'd like to know why you are so interested in the European banking systems when it is clear from the share price performance of all banks in Europe compared to those banks in America, that banking in Europe is fundamentally unprofitable. Can a few distressed opportunities, that, by the way, you are very good at doing, and that's why you're a bit of a hero to us, really reverse the problem of a structural lack of profitability?
Well, Ruth, as a specialist, as we are in a whole range of financial services globally, we have a long-term interest and success in investing in commercial banking. And the way I would put it is that banking in Europe has low profitability, not that it is fundamentally unprofitable. Right now, it's quite true that banks in the United States are much more profitable than in Europe, and their trading prices reflect that as they should. And of course, there's a trade-off between price and what you get for it. And right now, we see opportunities potentially for distressed opportunities among European banks, something which we don't see at all right now in the United States. And yes, a low price can make a lot of difference. The real problem with European banking is negative interest rates. There are other problems too. The speed and path of return to adequate profitability certainly depends on a number of other factors, such as obviously how long the crisis lasts, how much government support is available for borrowers, the fate of the euro, and if the euro continues, the arrival of a euro-wide deposit protection scheme. And obviously, consolidation among banks to increase efficiency is part of the solution, but it is pretty hard for a wave of consolidation to take place until most of these issues have been resolved. But in the fullness of time, supply and demand will eventually adjust the amount of capital in European banking and enable to provide for an adequate return, but I'm not making any predictions how long that's going to take.
So leading on from that, Brussels would have us believe that a banking union would help us to tackle, as you say, the negative interest rates, of course, have been in place for a long time, in fact, since the crisis, in many cases for European banking, for the European banking sector, and QE has not helped that. So do you believe that Europe should move towards Brussels' hope of a banking union, or do you think that, in fact, we need to address wider issues than that? And as you said, if the collapse of the euro is a real possibility today.
So let me put it this way, if I may, Ruth. I do think a banking union would help. I would say, in order of priority, in my opinion, the problems are: 1, negative interest rates; 2, this crisis; 3, concerns about the euro; 4, that markets are really national and not European, making consolidation difficult. And in Germany specifically, number 5, the whole Sparkassen system, which of course is not shareholder oriented. Whereas I think either irrelevant or not a major problem, I think regulation in Europe is good. I don't really think that's the problem. I think Europe's lack of technology giants is irrelevant to this problem, and there are many markets around the world where banking is very successful, aren't America or whatever. And of course, the lack of GDP growth, doesn't help, but I don't think that's the main issue. But a banking union, really seriously, European-wide, would make a big difference.
So at the moment, of course, there are greater unity and strides from the regulators, at least, to give banks a break, so to speak, and to bring together, hopefully, all of the banking systems and all of the financial systems to help us all survive whatever is coming next, right? Hopefully this is a unique experience and hopefully it will end soon. But because we're all in the dark together, it's a difficult time for everybody. To my mind, the banks have been given an easier road than other parts of the financial institutions, such as insurance. Obviously, they're integral to the capital markets and the global economy. Given that whilst banks are seeing support from regulators and central banks in various ways, such as term funding facilities, do insurers need such support? And how do you view the viability of the sector post-COVID?
Well, insurance has its own particular set of issues which are and opportunities which are very interesting. I think one of the key points about non-life or property and casualty insurance, as we call it in America, is that the losses from this crisis will be, without a doubt, by far the biggest insured loss ever in the history of insurance. And even if, take, for example, business interruption, health claims, et cetera, even if policies don't seem like they provide for business interruption protection, certainly in America, you'll recall it's state by state, and there's class actions, and plaintiffs are, are going to be an appealing bunch. So anyway, it'll be big costs for sure. So what does that mean? And there'll be also losses on the investment side as well. So what that means is less capital, and that means big increases in rates. So we're seeing, it was already happening before the crisis hit, but we're seeing dramatic increases in rates. And that presents a very interesting opportunity.
And what would you like to see from that opportunity for the insurance sector? What would you like? What would you predict they could achieve?
Well, I mean, it's it's sort of like being an investor. When the stock market goes down, you feel bad for what you own, but you feel happy about what you're going to buy next. In the same way, for the insurance industry, of course, these losses inflicted on it are unpleasant, but for the prospects for new business are very attractive. So for people like us, investors like us, looking for ways to deploy capital against those rising rates, is a very attractive idea.
Excellent, thank you. Leading on from that, obviously the banks themselves are under pressure, not least because of the payment holidays that are taking place across the globe. Of course, we've seen that the governments have stepped up and hopefully are trying to support both the masses and the banks themselves. But whilst banks are being provided with plenty of liquidity to address the short-term disruptions caused by these payment holidays, the more fundamental credit problems may start to emerge and may even be exacerbated by the payment holidays. With bank capital risk weights arguably pro-cyclical, how much should we be concerned about a downturn both in commercial and residential mortgage markets?
Well, I think so let's take the commercial mortgage market, or let's just take the commercial real estate market, which of course is funded by commercial mortgages. I think it's perfectly obvious that many parts of that are being adversely affected. Obviously, retail-oriented property, some questions around commercial office space, et cetera. Hotels affected too, although one would think that is more of a transitory problem, because people will be going back to hotels. So what all that means, I think, is lower prices in commercial real estate. It means losses to some extent for commercial real estate lenders, and all that's going to flow through. I think residential is better in a different story, where, of course, there'll be some, increased delinquency and arrears and so on for borrowers who have lost their jobs. But I don't think it'll have a big effect on the price of residential property or mortgage lending in the long run, and lower interest rates do help support that. Yeah,
we're seeing a boom, obviously, in people looking for houses outside of the old capitals, right?
Right.
Now, the attractiveness of living in central London has definitely waned, and I'm sure the same is in New York. I find it interesting that, after all of our pontificating, particularly in the UK, around our very overpopulated southeast, that now this could be the solve almost, the fix to the problem that we've been experiencing for such a long time on the pressure of housing markets. So we'll see, right? But it could be an opportunity for someone who has a house outside of London, and that's quite exciting.
Right.
So just moving on to the sort of the general impact of the pandemic, how do you think the COVID-19 experience will change the role and nature of banks? Do the different national economic responses to the epidemic, regulatory, fiscal and financial, fundamentally change the future landscape of Europe's banking systems?
So I don't think the COVID crisis will have much of a long-term effect on the role of banks. Of course, it's different from the global financial crisis in that banks are not really the villains here, and to some extent instead are seen as part of the helping to offer part of the solution. And while the details differ in various European countries in terms of the support and what have you that they're offering, on the whole, their effect is similar, and what central banks are doing is also similar. So, and I think, by the way, those steps by governments and central banks have been good. So I think the effect of COVID will be on the banking system will not be a sort of a permanent change. It will be, obviously, it will have impact on profits in the short run, and if this persists long enough, it could have a big impact on profits. But I don't think it will change the nature of banking.
Okay. As someone who has arguably seen more hands-on experience of the crisis, in fact, the last big crisis that we faced, essentially, can you explain what similarities you're noticing at the moment in the speed with which regulators are responding, and indeed national governments? As you say, banks are now seen as hopefully part of the solution rather than the problem this time round. But also, could you explain what it's actually like to be in the room when something so seismic something so seismic happens that you can see money basically stopping to turn the world within a matter of minutes?
Well, it does feel different this time, and at least as far as the stability of the finance system, much better. I'm not sure about the economy is a different story, but and I think that the world, governments, regulators, et cetera, learn some lessons which are now being put to good use. So for starters, banks and financial companies have much better liquidity and much stronger capital. And really, I don't see any liquidity problems to speak of among financial institutions, and that is completely different from 2008. And also, they have a lot of capital, which gives them the ability to absorb, losses that arise from the crisis. Of course, if they're big enough and long enough, et cetera, it's still run out of cap. But they're much better shape in terms of absorbing losses this time around. And I think, to your point, Ruth, I think the authorities, having seen, if you will, a version of this movie before, and now seeing the sequel, have acted with an alacrity and with a decisiveness which is striking and different from last time, and I think very helpful. And you can really, when the market bottomed on March, it was really pronounced. March 18th bottom for now anyway. That's pretty quick action when the authorities stepped in at that time.
And can you describe for me what it is like to be in the chair when things start to stop, basically?
Well, it's different.
It's coming.
It's different from the following says, I was, like literally there when Lehman went bankrupt, and it was at the Fed and so forth. It was very, very dramatic and acute. It was acute. It was like hours and minutes and days, and it was sort of like the Titanic hitting an iceberg, and as the engineer said, is a mathematical certainty that she will sink. I mean, that's what this time is quite different. So it's slower in its development. The issue is more losses, delinquencies, credit losses. It's not an acute issue, and so it's not so much a minute to hour thing. It is instead the very difficult job of trying to figure out what's going to happen. How long will this last? What will governments do? And what will the effect be? So not as dramatic.
No, of course. If we knew the answers, then of course we wouldn't be sitting here probably.
We knew the answer, right? Exactly. I think, by the way, it's not like if we all worked harder we would know the answer. I don't think the answer is knowable.
Exactly. Yeah.
Right now, it's just not knowable. But that doesn't mean, as not that you're suggesting otherwise, that we can't be thinking about, well, this could happen and that could happen, and what does it mean, and so on, which of course we and others are doing.
Yeah. Well, hopefully it will create, you know, as we've said, you know, hopefully it will create opportunities for longer term, you know, stability, etc. But no one can ever predict a pandemic, right?
No. Well,
I just can't.
I guess we should have known that they were going to get pandemics every now and then. I'm not sure I really knew that, but maybe not anyway. But
Yeah,
you're right.
but
Who can predict this?
yeah, I mean, it feels more to me like, you know, it's quite a leveling experience for everyone across the world to all be in the same position at the same time. It's quite unusual.
Yes.
So that in itself is a nicer feeling, I'm sure, than 2008.
Yes.
And a more steady feeling. Just to finish up, obviously, I'm very grateful for your time and our delegates. The conference is a very well-established conference in people's diaries and in the capital markets. And all of our sponsors and delegates that I've spoken to, who I've known for a long time, we're very pleased to hear that you were going to speak to us. And so we're very grateful. And particularly because some of them work, you know, minute to minute, of course, is a regular thing on a trading floor. But to know that someone who has experienced, as you said, you know, literally Armageddon in front of your eyes almost, was an exciting thing to hear. So just to finish up, I wondered if you could give us, or give me, your hopes for the next year, sort of the next, I think 12 months is a ridiculous amount of time to speak about at the moment, but your hopes for the next sort of 12 weeks and 24 weeks in terms of what you'd like to see in America's economy and across the world as marks in the sand that you think would be good progress for you to monitor.
Well, I you know, what I will say is not something that, you know, that I'm sure we shared by many others. So of course, the idea that we'll come out of this, things will start to loosen up, and we won't have a second wave leading to some further lockdown is the main point. You know, I think that if this, you know, if we're sort of starting to recover by the end of this year, and 2021 is year of recovery, so maybe the GDP will be lower in 21 than 20, but it's sort of on the way up. You know, I think that will be manageable. You know, whereas if we get another big breakout and everything gets locked down again, I think that'll be quite difficult. But you know, of course, I don't know, no idea what will happen.
No, of course. Well, thank you very, very much for your time. I really appreciate it. And I know that everyone that we should have been in front of will be looking forward to logging in to seeing this video on the 16th of June. So thank you very much.
Thank you very much, Ruth. Nice talking to you.